What is going on in the markets right now? When should I be concerned? When should I not be concerned? Listen, everything comes down to the fundamentals. And today we're going to be talking about those fundamentals, the things that you need to be paying most attention to. So stay tuned.
Retiring Well, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well, where we believe your best is yet to come.
Listen, welcome to the show. Today we're talking about the fundamentals of the economy, the things you need to be paying attention to. There is a lot of bad news out there. Fourth quarter of 2018, we saw a lot of that between China trade war, the Feds raising their rates. There was so much bad news, Brexit, and people reacted to that. But what I want to show you today is the things that you need to spend more time looking at, the things that are probably the most important. Now at Centennial Wealth, we do this for our clients every quarter. We have a luncheon, we talk about these fundamentals, but today folks, we're going to give it to you so you can see kind of the things we're talking about with our clients, so you have a better feel for where things are in the market. 10 years now we've been into this bull run. Now the definition of a bull run is when the market has not had a greater than 20% correction, meaning went down by 20%, and that lasted longer than 2 months. We haven't had that since March of 2009. It's also why people are getting nervous, because it's been so good for so long. It's like, when is the shoe going to drop? You look at the major indexes. 2017, everything was up. 2018, everything was down. And then all of a sudden, the first quarter of this year, things are starting to look good. But can we trust it? Well, let's look at the backdrop. Let's look at the fundamentals to see if we can or not. Interestingly enough, when we've had a January and February like we've had now in 2019 be up, well, if you look historically, it's been typically, the year has ended up averaging about 24% when that's happened. Good sign. Anytime we've had a greater than 15% correction in the market, look at this, it's typically followed by 55% returns. Not bad. This is just the S&P 500 the last 2 years. You can see in 2017, market was going up, up, and up. Then we had the Tax Reform Act, and then it shot up in January of 2018, only to be followed with a big negative in February of 2019. And then we had some trade war concerns, the rising wages, and a number of things that were causing concern. It got a little bit volatile, and then all of a sudden everything started going up. And it kind of peaked in September, hit an all-time high. But honestly, folks, what was odd about that rise is the S&P 500 as a whole was going up, but that all came down to about 5 different stocks. It was basically those FANG stocks: Facebook, Apple, Amazon, Netflix, and Google. If you didn't have that half a dozen stocks in your portfolio, you weren't seeing the increase. And then in September it peaks, and then all of a sudden that last quarter, most particularly in December 2018, almost dropped 20%. And now we've seen in the first quarter much of that coming back. What's interesting about what I was talking about with those FANG stocks, that growth we see, if you take the S&P 500, it's a weighted average, meaning that those that have a greater market share in the economy have a greater part of that S&P 500. So if you look at the index, it's just not all 500 equally. But if you look at that equally, you can see this black line. You can see that during that period everything was going up. All 500 companies were, for the most part, if you gave them an equal weighting, meaning 0.2%, right, was going down, even though the S&P 500 was going up. That was a concern as we were approaching that, because you know, if you're going to look at the S&P 500, you want to see it as a whole do well. Well, all of a sudden now you look at the first quarter of this year and everything's going up. All 500 stocks are sharing in this, so this is a very good sign. This is just the S&P 500 compared to what's called the world index. Okay, it's everybody else but us. As a general rule, you can see that our markets follows the world market pretty much in tandem. We are much more globally connected than we realize. Just think about it. If you go overseas or have traveled in any way, you'll see, if you look down some of the streets, you can see nothing but American companies. That's because our companies, our corporations do business overseas. If they're doing good, as a general, we're doing good. Now, you can see where this was starting to separate. Our economy, our market was doing well when the rest of the world was not. That was a concern. And two things either happened. Ours was going to come down to meet theirs, or theirs was going to come up to meet ours. So we were kind of concerned. Ours started to meet theirs, but now of recent this quarter, we're both working in tandem. We're both going up. So listen, I encourage you to stay tuned because we're going to talk more about these things. We're going to talk about the fundamentals. And I ask you, is your advisor right now talking to you about these things? How are you positioned? This is where you might want to give us a call so we can get into more detail of this kind of stuff for you, to show you where you want to be positioned in this market, in this economy. So stay tuned.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, June 4th at Big Buck Brewery in Gaylord. Wednesday, June 5th at Boone's Long Lake Inn in Traverse City. Tuesday, June 11th at the Evergreen Resort in Cadillac. Or Thursday, June 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
Hi, welcome back. All right, in the first segment, I was talking about some fundamentals. We're going to talk more about this, the kind of things that we want to be paying attention to. We don't want to get caught up in all that negative news that goes out there. We don't want to react to that. We want to know what's really going on in the economy. All right, well, the first thing I want to share with you here is GDP growth. Very important. The definition of a recession is when you've had 2 quarters of negative GDP growth. So when you start to see GDP growth start to slow down, we want to be starting to pay attention, right? Well, you can see 2016, the GDP growth. 2017, 2018, even better. Now this was weird because in 2018, the S&P 500 as a general rule was down, yet GDP growth was strong as it's been in quite some time. And now, first quarter 2019, the first estimates that's coming out is showing it just a little over 2%. Not much different than what we've had. Very good sign. No signs, at least so far, of any kind of slowing. Unemployment, lowest it's been in 50 years. Okay, this is good because when we're looking at fundamentals, if more people are working, there's more money in their pocket, which means there's more spending, which is good for the market as a general rule. So low unemployment is a good thing. But this is a chart quite interesting. When unemployment has been at its lowest, the market has actually peaked. So this is something we want to pay attention to because if we see unemployment on the rise, that may be an early sign that the market might be going the other way. Right now, no signs of that, but something that we're going to want to be paying attention to. Now, when can we see unemployment maybe taking a dip? Well, this is an interesting index. As a general rule, when you've seen housing start to take a dip, that's a leading indicator that unemployment is going to follow on the down. So this is something we want to pay attention to. You know, if housing starts to slow down, then we know unemployment's going to be on the rise. And when unemployment starts to get on the rise, then that's a leading indicator that the market might start to follow. Right now we don't have that, because as we look at housing, it's still on a trajectory of doing very, very well. It started to take a dip. This is median sales prices, or median homes sold in the U.S., and you can see now of recent it's kind of took an uptick again. I think most of what drove that dip was when mortgage rates started to get up a little bit. Now they've kind of come down, and it's kind of added some fuel to the real estate market. This is just, when we talk about housing, you know, many people are saying, is this like 2008? Are we in a bubble? Is a bubble going to burst again as far as real estate goes? Is there anything we need to be concerned about? Well, if you look at this as far as housing affordability, right now it's at about its average. Right now, what 140 means is people have the ability to afford 140% of the value of the homes. But that's been the average. So I'm not seeing indications of a bubble at this point. So I don't think we have those concerns. This is interesting. This is just the labor participation rate. You know, many people argue, yeah, the unemployment's low, Larry, but isn't that because a lot of people have just left the workforce? You know, what's that participation rate? Well, this is an interesting chart. If you look at recently, you can see labor participation rate is actually on the increase. That means people that weren't working are now entering the workforce because it's becoming more attractive. I think we should, as this happens, as wages got a little bit, if jobs have been needed, people are entering in and say, okay, this is worth it. Why is that good? From a fundamental standpoint, if more people are working, more money in their pocket, good for earnings, good for the market as a general rule. Interesting enough, you know, if you follow this blue line, that's unemployment. That orange line, that's job openings. For the first time, we just recently crossed the mark where there's more jobs open out there than there's people to fill them. Now, we've seen, we're going to talk about this a little later, but we've seen wage growth kind of stay good, but not necessarily on the rise. And that's because people were filling jobs. When you start to see this happening, when there's, you know, more people to work, you know, more jobs than people to fill, you're going to see employers having to pay a little bit more, and that's going to make wages grow. Why is that good? More money in people's pocket, better for earnings, better for the market. All right, this is inflation rate. As a general rule, you know, if there's more money in people's pockets and greater demand, you're going to see inflation on the rise. But for the most part, it's kept pretty intact. Now, I'm going to talk about this more because Federal Reserve is watching this very closely. So stay tuned. But I ask you again, are your advisors talking to you about this? Are they telling you the things that you need to most be paying attention to? I encourage you, give us a call if you want to hear more about this. Stay tuned for the next segment. Where are all your assets going to go when you pass away? Do they know where to go? Who's going to make the financial decisions for you when you can't make them for yourself? Who's going to make those healthcare decisions for you when you can't make them for yourself? Listen, these are all issues that can be addressed in any good estate plan. So I encourage you, give us a call, let us come alongside of you and put the proper processes in place to make sure you have a good estate plan. Give us a call.
Today's retirement challenges can be mastered. Knowledge is power because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, June 4th at Big Buck Brewery in Gaylord. Wednesday, June 5th, at Boone's Long Lake Inn in Traverse City. Tuesday, June 11th, at the Evergreen Resort in Cadillac. Or Thursday, June 13th, at Stafford's Bayview Inn in Petoskey. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated Financial Decisions. Call 888-608-5825 today.
All right, in the last segment, I started to talk to you about inflation, you know, how that's kind of in check. It's running around 2%. The Federal Reserve actually has a dual mandate. There's two things that they want to do. They want to keep inflation in check. Typically, they want to keep it around 2%, and they want unemployment to be low. Two things that kind of work in opposite of each other, because as you have low unemployment, that typically means higher inflation. So they want a healthy balance between those two. For the most part, that's been staying in check for quite some time. All right, but wages have not necessarily been on the increase. Inflation has not been on the increase. So the Feds have been slowly raising their interest rates. December of last year, they basically raised it to 2.5%. But then all of a sudden, in fear, the market started to react negatively to this because some felt the Feds were overreaching, like they were jumping too soon on interest rates when inflation wasn't necessarily showing that. So all of a sudden they've kind of taken more of a dovish tone now, and they're saying, you know, where we thought we were going to be raising rates in 2019, we're not going to be doing that. We're going to be maybe holding back, and they're allowing this economy to have a little bit more momentum. So we'll see where that goes. Just to show you what an impact the Feds can have. As the Feds were increasing, you know, the money supply, you can see the markets were reacting favorably, and then all of a sudden when they started talking about, you know, lowering their balance sheet or maybe going lower, the markets were starting to react accordingly. And now you can see they've kind of held back and say, maybe we overreached, let's slow that down. Again, U.S. wages and salary growth, for the most part, been increasing, but not at the rate where I think we need to worry too much about inflation, at least in the near term. Just the CRB commodity index, it's just a basket of 19 commodities that it follows. You can see in 2016 kind of hit a historic low. It's been, for the most part, hovering down below, although it's increased somewhat, maybe another 25% in the last few years, but something we want to pay attention to. I think there's a lot of opportunities in this market. If we even get back to where it was at, that's another 50% return. U.S. dollar, we follow this because in 1973 they compared our currency with the rest of the world's currency, and they baselined it at 100, and then ever since we've been following that. If you follow this the last 5 years, it's remained pretty close to, you know, that 100 mark. Real no big concerns as far as our currency related to the rest of the world. U.S. consumer sentiment, all-time high. I mean, the consumers are feeling good about the economy. Why is this good? Because the consumers are feeling good about the economy, they're willing to spend more. If they're willing to spend more, that's good for earnings, that's good for the market. Small business sentiment, all-time high. Matter of fact, they're saying it's higher than it's ever been since 1985. That's good because this, just like consumer sentiment, if small business is feeling good, that means they're hiring people, they're making capital expenditures, they're expanding. U.S. manufacturing index. Anything above 50 is expansion mode, anything below is contraction. For the most part, we've been in expansion mode for quite some time, but of recent, it started to take a slowdown. Now, I don't know how much tariffs are having an impact on this, but although we may still be in expansion mode, because we've started to see a dip in that, we want to make sure that that's not a negative trend. Same thing with non-manufacturing. Basically, well into expansion mode, but something we're going to want to follow. This is what we call the price to earnings ratio. listen, as a general rule, the market will trade at a multiple of its earnings. Historically, it's traded at about 17 times earnings. So that's what fundamentals are about. It's all about the earnings. Anything that's going to affect earnings is going to eventually affect the market, because if earnings go down, the market will go down accordingly. So price to earnings ratio is something we want to pay attention to make sure we're not getting into overvaluation territory. You can see here 5 years ago, it was right around 17 times earnings, which is the average, was getting a little bit high. We were getting somewhat concerned about that, and then of recent has kind of come back down to where it needed to be. Now, if you don't think earnings are important, look at this dark line. All right, going up. This is corporate earnings. That light blue line is the S&P 500 going up with it. As you can see, earnings are very important, because as earnings rise, so does the market. As earnings decline, so does the market. So always something we want to pay attention to. Now, folks, again, I ask you, is your advisor talking to you about these things? Do you know what the fundamentals are? If you pay attention to the things you need to pay attention to, you're not going to be as concerned when markets get a little bit volatile. So I encourage you, stay tuned, because we're going to talk more about these fundamentals.
Today's retirement challenges can be mastered. Knowledge is power, because you can confidently plan ahead and make educated financial decisions for a successful and comfortable retirement. We are Centennial Wealth Advisory, financial advisors specializing in retirement planning, serving all of northern Michigan with offices in Traverse City, Cadillac, Petoskey, and Gaylord. And we invite you to an informative and exciting live event with a complimentary gourmet dinner. You'll learn highlights of the new Tax Reform Act, the difference between the fiduciary and suitability standard of care, how an IRA gets taxed to a surviving spouse, how two similar portfolios can end up with two drastically different results, what a bull market is and how long it can last, and much more. Call 888-608-5825 to register and choose the date and location that works best for you. Tuesday, June 4th at Big Buck Brewery in Gaylord. Wednesday, June 5th at Boone's Long Lake Inn in Traverse City. Tuesday, June 11th at the Evergreen Resort in Cadillac. Or Thursday, June 13th at Stafford's Bayview Inn in Petoskey. The live event starts at 6:30 p.m. and is free to attend with a complimentary gourmet dinner to follow, but seating is limited and fills quickly. Call 888-608-5825 to reserve your seats today. There is no cost and no obligation. Don't miss this important live event. Educated financial decisions. Call 888-608-5825 today.
All right, as I was talking about in the last segment, everything is about earnings. That's what fundamentals are all about. Anything that's going to affect corporate earnings in the future is also going to affect the market as a general rule. So that's what we want to be paying attention to. So corporate profits, been steadily on the rise, been a good sign. If you look at corporate forecasts, again, trending upward. These are all good things for the market. When we see these start to go the other way, that's when we want to start paying attention. This is just, you've heard a lot about this in the news. It's starting to get, of quite concern is with all the Tax Reform Act and how well corporations are doing, how much money are they spending towards corporate or stock buybacks, right? How come they're not putting that money into, more capital expenditures, expansion, which is good for the economy, right? Or dividends, which is good for the consumer. True, in the market, in the news, you've heard where, corporate buybacks that hit all-time highs have peaked. But based on this chart, if you can follow it from dividends to capital expenditures to stock buybacks, everything's actually been on the rise. So this is a little misleading just to say that stock buybacks is solely where they're putting all their money. They're actually, the amount they're paying in dividends and capital expenditures has been on the rise of recent too. So not sure that's the sole problem. Now, would we like to encourage corporations to do more towards capital expenditures and paying dividends? Absolutely, but I get a little concerned when they talk about legalizing that or making it a bad thing, because for corporations to buy back some of their stocks, sometimes there's some good reasons. Just as the volatility index, this is just measuring how volatile the market is. And honestly, this is just an indication of, at any given time, this algorithm that goes through this, it's kind of complicated, but basically what it's predicting is how volatile the market they think is going to be in the next 30 days. So a VIX rate of, let's say, 20 means that they think the market's going to either be up by 20 or down by 20 in the next 30 days. Okay, and the greater that number, the more volatile it is. A low VIX number means less volatility. Okay, as a general rule, the VIX rate usually runs around 20. That means there's, volatility is kind of on average. When we see that be too low, that's a sign of complacency, maybe too much complacency if it gets too low. If it gets too high, it means a lot of fear that's happening. You can see over the last year, it's been all over. But as of recent, it's kind of settled about where it's always been, which is a good sign. Yield curve, hearing a lot about this in the news. Where there's been an inversion of the yield curve, it's been a predictor of a recession coming down the road. Okay, now where's a flattening of the yield curve? This is when the long-term rates meet the short-term rates or inverted or go the other way. Much of a concern. Now if you look at the 30-year Treasury rate compared to the 5-year Treasury rate, you can look at 2.81% versus 2.23. There's a difference of almost 0.5%. That's not unhealthy. That's not a flattening or an inversion. And it's been kind of hovering around that for a few quarters now. This is the 10-year rate versus the 2-year rate. Okay, getting a little bit closer, but still not flattened or inverted. So what was it you were hearing in the news? It was basically the 2-year rate versus the 3-month rate. Now it inverted, which caused a lot of concern, but what we really have to be paying attention to is how long is that going to last. Usually for this to be a good predictor or be something we need to be concerned about, that has to last for longer than maybe a 3-month period. And I would dare say it would have to affect the 10 versus 2 versus the 30 versus 5 as well. So although it's something we want to pay attention to, it's not necessarily meaning we're there yet. Now, in an inverted yield curve, if you look at this in the past, where the 10 versus the 2 has happened, look how many months it's taken before we've entered into recession. Quite a while. And what's the market done between when it's inverted and then finally got into recession? Returned about 12%, right? So when this happens, when this inversion happens, it doesn't mean we're in recession now. It means it's coming. Now, I've shared a lot with you today. There's even a lot more that we even share with our clients when we meet with them, because I only have so much time to go over this stuff with you. But fundamentals are very important, because if you're paying attention to the things you need to pay attention to, you won't overreact when you're hearing a lot of market bad news. Now, these are things that we're constantly paying attention to at Centennial Wealth. They're things that we want you to understand, so I encourage you, give us a call. We'd love to sit down with you, share a lot more of this stuff with you, show you how you're invested and how maybe it's in relationship to this, and make sure you're in the right place. So I encourage you, give us a call. Thanks for joining us.